So this is exciting for me. I don't do a lot of presentations, so I wrote this down and I actually scaled it back. So we're not going to talk about trading. We're just going to talk about basically what ETFs are. I got some feedback. I gave this presentation to somebody and they said this is just too much. And I wanted to keep it at 5 minutes. So hello, everyone, and thanks to Juliana for organizing this, and thanks to the other presenters for the awesome content. My name's Andrew Matt, and I'm a software developer, but early in my professional life, I was a licensed investment advisor here in Ontario, Toronto, Ontario. So I spent nearly 2 years in financial sales without anyone to tell me explicitly how to invest my clients' funds. And so as you can imagine, that was really difficult for me to do properly. So I was really nervous for about a year, and I did so much research myself about testing technical indicators, reading Warren Buffett, reading all kinds of stuff. I read and read and read and read and read. And in my undergrad, I had done math and economics, but I feel like it really didn't prepare me for actually investing, and especially not other people's money, because you can imagine the stress that is, well, it's not my money. I mean, I feel even worse if I lost somebody else's money. So the best trade that I put somebody else into that I didn't actually even have any money at the time to put funds into was Tesla. And it was 2012, and it was under $30 per share, and now it's over $1,000 per share. So one of my clients was so happy with me about it, because even in that year, it more than doubled. But it's done even better since then. But I don't waste time getting upset about missed opportunities because I have a system. I don't pick stocks anymore, and I don't do research anymore. I just now buy ETFs, or some people call them equity indexes. ETF stands for exchange traded funds, but I'm going to build up on top of that from what stocks are and a little bit about mutual funds so that you can understand exchange traded funds. So this is not advice for anybody, but I hope it helps people understand more about the subject so they can start thinking about investing in case they haven't started. If you are already investing, I imagine you'll know most of it already, but you might learn something, you never know. So a stock, companies can issue public securities that trade on markets in the form of stocks. They represent ownership in the company. One share of ownership is just one piece of ownership. It's not a percentage. It's because there are so many, there are companies that issue millions of shares, and so it's not a percentage, but it is an equal percent ownership as compared to the one stock is worth another stock in the same company. Anyway, so ownership of a company means ownership of that company's profits, and the price is largely unreasonably volatile. From one day to the next, it can dramatically vary. This means that there's opportunity to buy shares when they're undervalued and sell them when they're overvalued, or at least reasonably valued. And I said opportunity. It's also opportunity to do the opposite. A lot of people lose money in the stock market. But here's the thing. So if you look at the long term instead of the short term, from day to day, it's very volatile. But even Warren Buffett says he doesn't know what's going to happen in the course of a year, but he does know what's going to happen in the course of 2 decades. And invariably, over the course of 2 decades, markets go up. And so this is great because we don't have to predict. We can just say, I know I want to retire in 20 years, so I want to put money into the market today and have it in 20 years from now when it's gone up. So you've almost undoubtedly heard of the term mutual fund. A mutual fund is a fund that has a manager who buys stocks for you, sometimes bonds, sometimes other instruments like currencies, but they manage your money for you. Eventually, investors notice that many mutual funds don't outperform simple benchmarks, such as the S&P. This is a big deal. It's a really big deal because the S&P is an index of just the 500 largest companies in the US. So if you just bought what are called blue chip companies, but 500 of them, you would outperform, I think, over a third of mutual funds. And so it's not just a problem of picking stocks, it's also a problem of picking mutual funds. You don't know what you're going to get. A mutual fund has a fee usually around 3% annually. And it's not like it comes off once a year and you can avoid it by buying and selling. It's every day they take a little bit off for their management expense ratio. An ETF is like a mutual fund, except it's passively managed. It's not as much work for the fund managers, so they charge a lot less. They charge usually less than 1% per year. So the management fee is way better. 2% year over year adds up a lot, big time. So ETFs are still volatile in the short run, but thanks to the diversity of an ETF, because you're getting 500 or 2,000 in some cases for the Russell index, it's more likely to go up than buying stocks individually. Year over year, they don't go up every time, but the annualized return is around 6%. So every year, on average, it goes up 6%. Some years it goes down, but on average, it's 6%. So 6% over the course of 12 years means that your money doubles. And so if you're still young and you haven't started investing yet for your retirement, you should probably really start now. The sooner you start, the more compounding can help you. If you feel like you're behind where you should be, you can also consider an investment loan, because many of us have more practice paying off debt than saving to invest. So you can find out more from your bank or any financial institution. There are so many ETFs out there as well. It can be confusing. So if you have an investment advisor or just a friend who loves to talk about this stuff, it could save you a lot of time, pointing you in the right direction. But there are a lot of resources out there. So this is just what works for me, not necessarily what you should do. I was going to talk about how I actually choose when to buy and sell. But for starters, if you're not just buying, right now is a really tough time in the world with coronavirus and what's going on with policing and Black Lives Matter and a lot of really difficult things that have been going on for even longer. But it is a tremendous buying opportunity for small cap stocks, which have not recovered since a massive crash in February of this year. So it also helps people get money out of the market when you buy. If they need the money and nobody is willing to buy it, then they have to sell it at an even lower price. So thanks for your attention. I'm happy to answer any questions.